Right now, most people think crypto is still risky, too volatile, too uncertain. But here's the strange part. The data doesn't agree with the price. While headlines stay negative, on-chain signals are quietly flashing something else. And historically, this exact gap between fear and data is where crypto has been most undervalued. Every cycle, retail investors repeat the same mistake. They look at price first. They wait for confidence. They wait for confirmation. But by the time things feel safe, most of the upside is already gone. Later, they say, "Why didn't I buy when prices were low?" The truth is, crypto only feels safe after it's expensive. Institutions understand this. Retail learns it too late. In this video, I'll break down why current data suggests crypto may be undervalued right now, even if price action feels slow or uncomfortable. We'll look at this the way institutions do, through on-chain behavior, supply dynamics, holder conviction, and historical valuation zones. No predictions, no hype, just structure and data. If you want data-driven crypto insights instead of emotional market noise, make sure you're subscribed. This channel is built for investors who want to understand value before the crowd catches on. Price and value ARENOTTHE same. Retail thinks price equals value. Institutions know better. Price reflects emotion. Value reflects positioning, supply, and conviction. An asset can feel boring, slow, or even dead, and still be deeply undervalued. In fact, that's usually when value appears. If crypto feels uncomfortable right now, that doesn't mean it's broken. It might mean it's mispriced. Data signal #1. Long-term holders ARENOT selling. One of the strongest undervaluation signals is what long-term holders are doing. Historically, when crypto is overvalued, experienced holders distribute aggressively. Right now, on-chain data shows the opposite. Long-term holders are holding. Many are quietly increasing positions. This behavior matters because long-term holders have consistently sold near cycle tops, not near value zones. Why institutions care about this. Institutions don't watch price alone. They watch who is willing to sell. If experienced participants are refusing to exit, it suggests current prices are not attractive sell levels. Conviction like this rarely appears in overvalued markets. Price moves fast. Conviction moves slow. Data signal #2. Exchange supply IS declining. Another major clue comes from exchange balances. When investors want to sell, they move assets onto exchanges. When they want to hold, they move assets off exchanges. Right now, crypto supply on exchanges continues to trend downward, even without strong price momentum. This is not panic behavior. This is positioning behavior. What this tells smart money: lower exchange supply reduces sell pressure. Reduced sell pressure creates asymmetric upside. Markets don't need massive buying to move higher. They need selling to dry up. Institutions understand this dynamic very well. Markets rise not because buyers appear, but because sellers disappear. Data signal #3. Sell side pressure remains muted. If crypto were overvalued, we would see aggressive profit taking. Instead, realized profits remain relatively low. Selling looks selective, not emotional. This suggests many holders believe current prices don't reflect fair value. Overvalued markets invite selling. Undervalued markets create hesitation. Data signal #4. Historical valuation comparisons. Institutions always compare the present to historical context. Across multiple cycles, periods with similar valuation metrics have historically occurred closer to bottoms than tops. Retail ignores history. Institutions anchor to it. Value is never judged in isolation. It's judged relative to past behavior. Overvaluation feels exciting. Undervaluation feels boring. Data signal #5. Network activity remains resilient. Another overlooked factor is network usage during low sentiment phases. If price falls and network activity collapses, that's structural weakness. But when activity remains stable while price consolidates, it suggests the underlying system still has demand. Institutions care about usage and relevance, not social media sentiment. Data signal #6. Leverage A&D speculation ARE low. Overvalued markets are crowded. Undervalued markets are quiet. Current data suggests leverage remains relatively restrained. Funding rates reflect caution, not greed. Historically, periods of low leverage have preceded healthier market expansions. Institutions prefer entering empty rooms, not crowded ones. If nobody is excited, value is often nearby. Data signal #7. Stablecoin capital is waiting. Another subtle but important signal is the presence of sidelined capital. Stablecoin balances suggest money hasn't left the ecosystem. It's waiting. This creates potential demand without immediate price pressure. Institutions don't chase moves. They prepare for them. Retail misreads ALLOF this. Retail reacts to emotion. Institutions respond to structure. Retail needs confidence first. Institutions accept discomfort early. This difference explains why retail often buys late and sells early every cycle. Undervaluation never feels obvious. If undervaluation felt safe, everyone would act on it. Markets are designed to make value feel uncertain. Fear is the price of opportunity. That's not a bug. It's the system. If it feels too quiet, it might be too cheap. What this data does not mean. Undervalued does not mean price will move immediately. Markets can stay mispriced longer than expected. Institutions understand time risk. They scale in. They manage exposure. They wait. Retail demands instant validation. Risk and reality check. Macro conditions still matter. Liquidity still matters. Risk never disappears. Institutions don't ignore risk. They factor it into position sizing. Undervaluation doesn't remove risk. It improves the risk-reward balance. Stop asking, why isn't price pumping? Start asking, is value building beneath the surface? Watch behavior, not headlines. Watch structure, not emotion. That's where advantage lives. Why value phases create teach biggest returns. Every major crypto expansion started during disbelief, not excitement. Value phases reward patience, discipline, and emotional control, not prediction. Big moves are born in boredom. Crypto doesn't become undervalued when everyone agrees it is. It becomes undervalued when fear dominates and the data quietly disagrees. Right now, that gap is widening. And historically, that's exactly where smart money begins positioning. If this breakdown helped you see crypto differently, subscribe for more data-driven insights, and I'll see you in the next one.